So, good evening, everyone. This is Abdullah Mashat. I have with me Wael and Abdullah, and we have with us a very special interview with Mr. Sven Henrich. So, we're very happy to have you, Mr. Sven.
Thank you very much. Glad to be with you, Abdullah.
Okay. So, today is March 16th, 2021, and we will be having a 1 hour session with Mr. Sven. We will start with 45 minutes asking him questions from the finance memo, and then we will proceed in the last 15 questions with some prepared questions from the audience. So let us just start with the first question, which is, can you please tell us information about your background and professional background and more about yourself? Thank you.
Okay, fair enough. I mean, I did not originally, I'm not associated with Wall Street in background at all. I came from the mobile wireless industry in international corporate development. For years, worked on development projects, Europe, Asia, South America, and so forth. And then did some startups in the software space, and then ultimately transitioned into trading. I love markets, love analyzing companies. And I started off just like everybody else, just learning my ways around, mostly looking at technical charts. And as I evolved as a trader, obviously became very much aware of how much trading and markets are influenced by not only the technicals, but also macro and central banks and so forth. And for the last 12 years or so, I've been doing this full time and joined Twitter in 2012, I believe, and also launched a technical service to share charts with people that are interested in terms of directional trades and so forth. And been commenting on the macro picture quite a bit in the last few years as well, in addition to technicals.
Thank you very much, Mr. Henrich, for the brief overview and the impressive, actually, background. If you can, since you're a well-known figure on the FinTwit, finance Twitter community, for having unique views, mostly bearish, can you please comment more about what do you see that probably others don't see?
Yeah, let me clarify the bearish aspect, because I'm often called a perma bear. As our clients know, we're very much flexible in both directions: trade long, trade short. The bearish aspect probably of my reputation comes from that I'm fairly critical of this global monetary system that has evolved over the last 12 years since the financial crisis. When we look at a crisis like COVID, for example, I have zero issues with intervention, and both monetary and fiscal. But I'm also looking at it in context of what's been happening over the last 12 years. And the central banks, which used to be the lenders of last resort, which they were meant to be, the backstop in case of emergencies. And certainly the global financial crisis was an emergency, as COVID was an emergency. But they've evolved to something much bigger than that. I used to call it the lender of last resort has become the owner of the entire resort. Central banks have not been able to extract themselves out of this process of permanent intervention. If you go back to 2009, QE1, which was the initial response to the global financial crisis with zero rates, these were supposed to be temporary measures, right? And the economy was supposed to recover, and ultimately then central banks were supposed to extract themselves. And they were never able to do that. In fact, we had QE2, we had Twist, we had QE3, and as the Fed tried to reduce their balance sheet, just ever so carefully in the time period of 2017 and 18, it completely failed. Right, as soon as the yields rose, it revealed that the economy that has been the global economy, in fact, that has been ever more reliant on ever more debt and cheap money, was not able to handle higher rates. And so when the 10-year, for example, in 2018 hit 3.2%, the entire market construct cracked. And we had a 20% correction in the fourth quarter of 2018. And then the Fed was forced to flip-flop. You remember the Fed's official mission is stable prices and full unemployment. Well, in 2019, we had no sign of a recession. We had 3.5% unemployment, which was historically low, and yet they cut rates 3 times. And they obviously added to their balance sheet again in response to repo. And so when COVID came upon us, the notion that central banks would be able to normalize. Remember, the Fed was actually the only central bank that tried. And I'll give them credit for that. They at least tried, right? But neither the BOJ in Japan or the ECB in Europe, they didn't even manage to get to zero rates. They stayed fully negative during the longest recovery, post-war recovery we had, right? There was no sign of a recession, but they all stayed on negative rates. So we came into February of 2020 with the highest market valuations ever, with negative rates all over the place, and the Fed having cut rates already. So this was already in advance of any recession having taken place. So my criticism with all this, in context of it all, is that we create the cycle of perpetual asset price inflation, which has consequences in the economy, because we see this vast explosion of wealth inequality. And what happened here with COVID, the response to the COVID crisis, all the central banks went completely, in my view, completely overboard. There's no scientific process that says, okay, we should add this amount of liquidity to save the system. I mean, you get to the point, and this is my criticism here of where we are now, is that they've completely overdone it, and they've put themselves in a box where now, even though we may now see fantastic growth, recovery growth from all this record liquidity that's coming into the system, not only from central banks, but now also tied to the hip with fiscal, as we just saw the third stimulus package in the United States with 1.9 trillion. They cannot even get themselves to talk about the potential for tapering, reducing, or even raising rates. They've actually completely disavowed the notion of data dependency. They basically just said we're not going to raise rates until 2024, no matter what the data says. And so my concern is that now we're looking at a global market with valuations the likes we have never seen before. The disconnect between asset prices and the economy is far beyond what we even saw during the tech bubble in 2000. And so there's multiple components here. Just to shorten this up real briefly, is my concern is that this excess that has been built and continues to build up until this point, while earnings are recovering and growth is recovering, it still leaves us with a major asset bubble. And that asset bubble, which hasn't cracked at this point, but if it cracks at some point, is a threat to the economy itself. Why? Because asset prices and economic performance and confidence on the side of consumers are now completely linked. You see prices go up in the stock market, everybody's confident. You got obviously massive retail participation now as well. You see people get hurt, you see confidence drop, you see the economy get hurt. So that's kind of the macro background as to why maybe I'm viewed as a perma bear. I'm concerned about what they've done and the complete inability on their part to be able to extract themselves from it. And at this point, now they've put them in the corner where they don't have a way out. They're not even pretending to have a way out. And so I think we're all faced with that construct, because let's face it, I mean, the world has massively indebted itself to fight every crisis, and the crises require ever more intervention, it looks like it, right? I mean, that's the track record. We need to do ever more to keep the system afloat. And in the process, we have this massive asset bubble with extraordinary wealth inequality. And I think ultimately there's a reckoning coming due at some point.
Thank you very much. If we may dig deeper into this, and in your opinion, the actions of the Fed took us to uncharted territory, as many have said. We would like to hear your take about what we'll be facing in the future, and where will this take us?
In terms of facing in the future, what do you mean by that?
In terms of more, as you can say, consequences, probably.
Well, look, I mean, at this point, it is a matter of control, and that's been my contention for quite some time. And clearly, what central banks have proven at this point is that they are retaining complete control. Although, what we now see with rising yields, it's a question mark, because ultimately, I think the fundamental question we all have to ask ourselves is any of this really consequence free? I mean, just looking at the United States as an example, I mean, we have gone from 5.5 trillion in debt in I think it was in 2007 to now $27 trillion in debt, and rising dramatically. I mean, we had a $3.1 trillion deficit this year. We're looking at probably around a $4 trillion deficit. I mean, $7.1 trillion in debt. And everybody says, well, rates stay low and therefore it's affordable. Well, the bond market is saying, well, rates are not that low anymore. They're starting to rise. So yes, you can have the greatest party ever with unlimited funds. And you can say, well, as long as we can sustain all that, that's fine. But we're seeing the ghosts of inflation creeping through. I mean, in the lead up from the great financial crisis to 2020, central banks never managed to reach their inflation targets, which was always 2%. Why? Because we have obviously massive technological trends in terms of deflation. I mean, technology is the greatest deflationary force the world has ever seen. That's one. And the other one, obviously, is demographics. And maybe that's the one that's probably the scariest, because no central bank can impact demographics. And the working age population in the United States has not only stopped growing, it actually is gone negative for the first time. And so when you look at all these obligations and what it requires to maintain some sort of growth projective, I'm deeply concerned that the Fed may be overstating or maybe overconfident in stating that they are able to control everything. I mean, obviously, central banks have become an ever larger part of the economy. There's not a central bank on the planet today that could even think about raising rates tomorrow, right? And we would know exactly what would happen in equity markets if the Fed raised rates tomorrow. I mean, everything would fall apart. That's how fragile this system really is, and that's how much we are in this corner. So we're coming out of this. And thank God we're coming out of this, because no one wants to deal with COVID, and we don't want a recession, and I certainly don't want a depression. But when we get out of this, we're looking at debt through the wazoo. We still have the same demographic issues, and now we have literally a population that is very much dependent on stimulus checks. We saw that today, right? Retail sales came down 3%. Some say it was weather, but reality is it's also related to stimulus checks. They got stimulus checks in December, then they ran out by February. Now you have another stimulus check. Great. That's all masking what's really going on, right? I mean, if we keep sending out stimulus checks, I guess we can have any economy that we would like. But what happens on the tail end of this? And this is the transition concern that I have. We're looking at probably 6, 7, 8%. I mean, the numbers keep varying of GDP growth this year, all of which is bought and paid for with free money, liquidity, debt spending, and deficit spending. And then next year, supposedly we have solid growth as well. But what does it really look like when we don't have new stimulus checks coming? What is the real economy, the organic economy, going to look like? Well, what every economist is telling you, the growth is going to slow back down to a 2% regime, right? That is, if nothing breaks, that if there's no new crisis, if there's no new major market correction, which would have a negative impact on growth. So my concern is a break in a narrative. Central banks say that at some magical point in the future, they will taper and they may even raise rates. Well, are you telling me we're going to go from a 6, 7% growth economy back down to a 2% economy, which is in effect slowing, and you're going to raise into a slowing economy? that's why I'm having a big question mark, because ultimately, at some point, we would like to see an economy run on its own, be able to function on its own. And we haven't seen this in 12 years. And I see zero path of visibility of that ever coming about, because either they're going to reduce their balance sheets or they're not. My bet is that at this point, the asset bubble that they have created has become so large that they're very much afraid of popping it. And we saw that in the last couple of weeks, right? We had a correction in February, the end of February. The concern was about rising yields. It hit tech pretty good, we're down over 10%. And immediately you saw the representatives from the BOJ come out and from the ECB, even Christine Lagarde, and literally say these rising yields are a concern to our economic recovery. So they know themselves that this entire construct is dependent on very much low rates and low yields, and especially they cannot afford the velocity of the rates suddenly rising very quickly. And that gets to the actually fundamental aspect of it all, because companies, they are having to deal with the effects of higher rates and higher costs and inflation, right? Because it eats into margins. And if that all of a sudden spikes very quickly, guess who's basically on the hook for that, right? Consumers. They're going to have to deal with it with higher product prices, purchase prices in the stores, and they may even have to get hurt by that in terms of hiring, because companies will make sure they maintain a tight cost structure, which they have already done here since COVID hit. So the end game here is very much unclear. And what I hope is that we don't get this massive inflation, because I don't think anyone wants to deal with it.
Thanks, Sven. We'll take a step back, and we would like to hear your take about exactly what happened since this rebound. What happened since the rebound of the COVID lows in March 2020 until we reach these all-time highs across a lot of different US markets?
Well, I mean, the March 2020 crash, I mean, it was intense. And the reason, I mean, we had a 35% drop in a matter of 4 weeks. I should point out, interestingly enough, the Fed was not able to prevent that. This is why I go back to valuations and all the printing and the rate cutting that had already taken place. Very important to understand. They didn't just start printing in March 2020. They had cut rates 3 times in 2019. In the fall of 2019, they had this mysterious repo crisis that came upon them without warning. That was a significant overnight spike in the lending rates, and the Fed was forced. This was not by their choice. They were forced to intervene to get those rates back down. And so by the time February hit, they had already added to their balance sheet to the tune of close to $500 billion. I mean, that's a massive amount of money. What happened with valuations was that the US markets had valuations of 158% market cap to GDP. And just to put that in reference, that was the highest we've ever had. During the tech bubble of 2000, the peak was 150% roughly. So we had already exceeded the valuation of back then. Charts were massively extended, and remember there was no earnings growth in 2019, so the S&P rallied 30% on basically these rate cuts and that balance sheet expansion in the tail part of the year. So what then exacerbated the crash was actually a very classic technical pattern, which was we had new highs in January, then we had a little correction, and then new highs in February that came on what is classic negative RSI, relative strength divergence. There was negativity in the internals. The banks were not participating. The small caps were not participating. So all this was developing before COVID hit in the charts. And so obviously COVID, the fear of COVID and the shutdowns obviously exacerbated everything. But this is when we had this historic crash. I mean, this was worse than what we've ever seen before in that short amount of time. And so at the March lows, you know, it was very clear that we had just historic oversold readings on these markets. We were vastly technically disconnected from moving averages. So it was clear a rally was coming, right? And so, and obviously the Fed cut rates to zero, and then they threw an unlimited QE. And then ever since then, it's been a nonstop rally, similar to what we saw at the bottom of 2009. And then we had a couple of corrections in the fall, 10% each, September, October. And then, of course, when we had the election, markets basically repeated what they did the year before, which was just a nonstop rally into the beginning of the year. So that's kind of what happened there. And I think now it's a matter of the expectations that have been brought forth by all this growth and recovery to be able to match the valuations that have also been created, which are also historic, in combination with some index charts that are completely outside any historic measurement.
The March 2020 crash was very, very fast, and it could be said that it was one of the fastest crashes in history. What was also unique, in my view, was the COVID rally. What has caught my attention is how high the VIX has been trading during this rally. I think the VIX has been averaging 23 during this rally. What are your thoughts on this? Is this something unique or anomalous, or am I just reading too much on this?
No, I think it's fascinating. I mean, we have all of us been watching. If you're looking at charts and technicals all day, the outstanding gap. And there's one thing to be said about gaps in index charts in general. You know, not all gaps fill. Most of them will eventually. But on the VIX, it's been my experience that eventually every single VIX gap fills. And so this VIX gap from February 2020, which sits around 17.5, is still unfilled. Although, for the first time now, this week, we're seeing the VIX drop below 20, at least momentarily. What's interesting to me in all this is twofold. First of all, I got to recognize it is highly unusual for the VIX to trade this high, especially in context of new market highs, especially in context of the rally structures that we've seen in recent months, where whenever you have a smaller correction, you know, the levitation machine, as I call it, goes back up, and we see very little intraday volatility. You know, you see, sometimes few ranges. A lot of the trading gains actually come via overnight gaps. So in context, of Russell, Dow, Nasdaq, and S&P making new all-time highs, by far in a regular trading environment, you would have expected the VIX to be at 10 or 12, kind of like what we saw in 2017. My experience with the VIX generally is that it builds longer-term compression patterns, and when they build, they lead to breakouts, and these breakouts can be massive. Now, I can't prove this on this call here, but our clients know this. Before COVID hit, my wife, who is also part of Northman Trader, she actually had made this insane call in 2019 in the fall. She said VIX 90 in 2020, and I was laughing about that. I mean, I didn't believe my own wife, but we got to VIX 86, so it was really close. And so from my perspective, it validated her technical work on that, and she again is seeing something brewing in the VIX, not immediately, but she made that call, and at the beginning of the year talked about this in one of my articles, that in the next 12 to 18 months the VIX is setting up for something very large again, which could exceed what we saw actually in March of 2020, as unlikely as that seemed, because that was basically, you would think, a once in a lifetime event. So the VIX here at this point, speaking about this week, this drop here in the VIX is completely expected, and I'll tell you why. because if you look at the VIX structure on the future side, every time we have OPECs, they tend to want to crush the VIX futures into rollover expectations. We had exactly the same thing in February, for example, almost to the day. VIX hit its monthly low February 16th, and yesterday got crushed to fill the gap that was left from the February up gap that we just saw. So in terms of the structure, what we're seeing right now is very common. I think the question now is, do we see another run up in the VIX, or will they finally be able to fill this February 2020 gap, in which case you could obviously expect to see higher market gains, more market gains to come.
You've mentioned the overnight gains on the S&P 500. So most of the gains, I think, in the past couple of years have been from overnight trading, not from the actual active trading. So what do you think is the cause of this? Is this anything different than usual market dynamics?
It is very unusual, and I'll tell you why. I mean, I am not surprised to see gaps. We've seen those for years. And you have sometimes gaps during obviously extremely positive markets. For example, we saw that in the run up to the January 2018 top. As you may recall, there was the US tax cuts that were passed. There was another one of those very aggressive year-end rallies on the heels of that tax cuts. And there were some gaps associated with that as well, right? And in general, my view is all these gaps eventually fill, sometimes not all, but most of them fill, and they did. In January 2018, that rally just exhausted itself, and then within days, we gave up the entire run from end of January into back to November, and all these gaps filled. And then obviously that gives you an opportunity for a tradable low when you see a lot of these gaps filled, because they're then pivot points of support. And what has differentiated this rally here is the fact that most gaps simply don't fill. Obviously, we had some aggressive gaps on the heels of the lows of March 2020, and fair enough. This was an aggressive bottom, and there was a lot of intervention, and maybe those gaps won't get filled for years or ever, for all I know. But what I'm seeing here now, since November, for example, is a little silly, I have to say, right? I'm looking at a 2-hour chart here of the S&P. And I'm counting 3, 4, 5, 6, 8, 9, 10 gaps here, all unfilled. 9 gaps that are currently unfilled. That is unusual. That is highly unusual, and typically what that would tell me is that most of these, or if not all, should eventually fill. That's clearly market history. So what we're currently seeing is very unusual, and part of it is simply obviously continued liquidity being pumped into these markets, anticipation, and so forth. So it's a bit disappointing so far not to see those fill, but to me they remain a checklist mark, if you will.
We've started seeing inflation expectations rising and also unemployment expectations decreasing. Do you think that the Fed will raise rates before the planned 2023, I believe, rates rise? And do you think this could be the trigger for an upcoming crash in the markets?
Well, I mean, first of all, the Fed, in my view, will do everything in their power to avoid even talking about raising rates. Recall in 2015, and this is a good example because it's the only reference point that we have. It was December 2015. Janet Yellen was then the chair of the Federal Reserve, and she implemented the first rate hike in December of that year. And guess what happened? Financials dropped 23% into early 2016. Remember, the backdrop was the earnings recession of 2015, 2016. And the bottom of that correction came in when the financials came on literally on the day when she said she's going to pause rate hikes. That's all that was paid. I mean, that's all it took at that point. So this codependency in how markets pivot off the Federal Reserve is obviously well established, but that was another one of those classic examples. And then they paused it and were able to then ultimately raise rates slowly. Why? Because other central banks took over the liquidity game. The ECB started printing more. The BOJ started printing more. So between 2018 and 2019, these other central banks added $5.5 trillion into their balance sheets over these couple of years. And then, of course, we had the U.S. tax cut in 2017, and that also provided cover. So I'm using that as kind of a script to say that they will be extremely careful because they know that actually a larger market correction is a major threat to the recovery. Alan Greenspan is on the record, says, 10% drop in equities is going to impact GDP by 1% roughly, right? So if you now had a major market correction, for example, all these growth estimates would come back down. So they don't want a market correction. They will never admit to that publicly, but that's the reality of it all. So that's why I'm saying it's the ultimate trap where they're forced to keep levitating these markets up. And so, and by refusing, and this is where I think they're making a mistake, because they've asked for fiscal stimulus, they got it. They wanted to instill a major recovery. Congratulations, they got it. But now we've transitioned from a period where central banks come in on any sign of trouble, and obviously crisis or recession or whatever, when they're supposed to act. We've now transitioning into a period where we have 6, 7, 8% GDP growth. Market valuations, yes, as of yesterday, were at a record 196.5% market cap to GDP. Remember my reference earlier from 158% for February 2020 and 150% the extreme peaks of 2000 and 2020. We're so far beyond that. And while I expect that ratio to improve with GDP growth this year, it's still completely outsized. So they put themselves in a box. I'm not going to call for a crash or anything like that. That would be folly, if you will. But given this valuation monster that they've built, there's really little room for error. And that's why, for example, tomorrow in the Fed meeting, we're going to be looking again what they may or may not say or hint at with regards to yields and yield curve control possibly, or whatever else that they may be thinking of. And the market is going to be watching this very closely. And this is where it's interesting what's been happening with yields and inflation expectations, because this run in the 10-year we've seen to over 1.6%, which is historically really low, right? But because of the velocity of the move, it started to bring in some concerns. And it also messes up with pension funds and their balances 60-40 bonds and stocks, because they may have to rebalance if this is not solved in a way. So there's risks building in terms of the fund flows, and the ECB has reacted, the BOJ has reacted. So far the Fed has not reacted other than words and referencing tools and so forth. And the Fed is so, you ask who's reacting to whom, if you will. But it's very clear to me in 2018, when this whole quantitative tightening failed and Jay Powell was forced to completely flip-flop on balance sheet roll-off on autopilot and rate hikes, and instead went to increasing the balance sheet and cut rates, that the Fed is very much beholden to markets. They're very sensitive. And we saw that with the ECB and the BOJ in the last couple of weeks. They are very sensitive to the market. So I think they're all very concerned to see a sustained market sell-off. And I remember last year in 2020, they couldn't stop that 35% drop, even though they were already printing. So it's going to be interesting tomorrow.
So given the high valuations in the US market, the only thing that should keep you invested is the Fed having your back. So for someone who doesn't want to take that risk, what are your thoughts on emerging markets? Do you think it's a good alternative for investors, or do you dismiss them?
I don't dismiss anything. Look, I mean, I posted a chart on Twitter this before we started the call. It was the ES. It's a weekly chart. It shows the trend currently is fully intact. I'm not one to call tops. I'm just one to point out risks. And we, obviously internally we are looking at risk reward when we like the long side and when we like the short side. I just know that when these trends break, everything is going to drop with it. And to me, at the moment the trend is intact, but I think you got to be aware that when a trend breaks, things could shift dramatically, especially in context like, for example, the open gaps that we mentioned, right? I mean, I wouldn't mind seeing those filled, but I can't tell you the when and how. So from my perspective, these markets, while they're overvalued and while the trend remains, they have continued upside risk. But if you see something break, then like in even 2013, which was one of those continued uptrend years, you will have opportunities where you see major technical reconnects, and then that's a place to maybe add back in, if you will, on the long side. And in terms of emerging markets, I think that's I'm not trading emerging markets, so I will not be able to tell you an educated opinion on that. I just view it all as the same trade at the moment. We're in a global liquidity trade that has lifted all asset prices beyond where you would think them fundamentally to be. And I'll give you one specific example: small caps in the United States. That chart, never seen anything like it. The chart is so far extended above just basic moving averages, like the 200-day moving average, to use a simple example. We have no reference point for that, or the weekly 50 moving average. And we have individual components in small caps. GameStop is a popular one these days, where you just see completely erratic action that haven't nothing to do with fundamentals. People are also excited about Bitcoin, which I completely understand. It's risen 1,000% in the last year. Well, we see some of these moves in some of these small caps as well. I think I posted a chart the other day where it showed, probably at least 15 stocks that had between 1,000 to 6,500% increases in the last year. That's not fundamentals. Right, that's speculation, that's excessive valuations, that's bubble activity where liquidity is trying to find a home. And to me, that's the excessive risk that, if these charts crack, then obviously we could have a whoosh down.
Sven, you mentioned Bitcoin. We would like to hear your take about Bitcoin. A lot have been calling it an alternative asset. It's the best performing asset in terms of growth for a lot of people. We would like to hear your intake about it in terms of technicals and also in terms of fundamentals. Where do you see it? What are your take?
Well, that's a big subject, isn't it? Full disclosure, I got inundated by laser eyes in recent weeks because I've dared to kind of poke fun at Bitcoin a little bit. Actually, technically speaking, I've been posting quite a few bullish setups over the last year on my site. Last summer we had, my interest is purely technical on that front, and my view was, okay, can we see technicals working in an asset such as Bitcoin? And last summer we had a beautiful inverse that worked to a T. It retested a breakout and then just moved on higher. Then, of course, as it is such a popular asset right now, it went completely vertical this year, very much like it did before when it had that original run up to 20,000. Bitcoin's, so obviously right now it's still in this bullish uptrend, although it just made a new high this weekend on a negative divergence. Proponents of Bitcoin, obviously, it used to be kind of sold as a currency, but I see increasingly that even big buyers of Bitcoin, institutional buyers of Bitcoin, actually more view it as a, call it an online bank, hedge against the fiat destruction vis-a-vis all the monetary printing. So just want to be clear, philosophically, I'm all with the Bitcoin people. If you want to have an alternative to what central banks are doing, philosophically, I'm all behind that. I think structurally, there's probably a couple of concerns that I have. I think in any type of adoption cycle of new technologies, go back to 2000, we had a slew of companies that were filled with promises of just an incredible future, and the stocks acted like it. Right? I mean, there was massive adoption rate and wild enthusiasm. And let's be clear: whenever you have a new technology like the blockchain, which I think is going to be an important component in terms of financial global management in the future, that will stay. I think digital currency will stay. I think my point is larger, is to say we cannot yet know who ultimately the winners will be. And the first dominant ones may not necessarily be the ultimate winners, right? You recall, Yahoo, AOL, and these companies that were big winners initially, but today hardly anyone is talking about them. Facebook is now the big winner, but MySpace used to be the biggest. No one's talking about MySpace anymore. It's not even part of it. I think it still exists, but no one's on there, right? Or very few people, relatively speaking. And so Bitcoin, now being the predominant cryptocurrency, it has issues in the sense that, yes, it's gaining a lot of attention, and the ones that are backing it need that adoption rate to be very steep. I think that there's a time window here. If you can make it large enough that it becomes virtually impossible to regulate, then I think Bitcoin can ultimately become a winner. But we're seeing some of these threats happening, right? We see it. India just mentioned that they may want to ban cryptocurrencies altogether, and Bitcoin. We saw here in the United Kingdom, IG is one of the trading platforms. They were just prohibited from trading Bitcoin as well. And you don't have a friend with Janet Yellen in terms of Bitcoin. You don't have a friend with the ECB. Now, I know Bitcoin proponents will say, well, they can't stop it. Well, go back to the 1930s and watch what a Treasury secretary can do. In the 1930s, there was a Gold Act, and they literally banned private ownership of gold, and all gold was confiscated. Now you can laugh and say, well, that's physical commodity. You can confiscate that, but you can't confiscate some code on the internet. Fair enough, but you can still make it illegal. Right? I'm not saying that they're going to do something like that, but I'm telling you that battle has still to be waged. And my concern is, Bitcoin headlines every single day, and the market valuations gets bigger and bigger. There is a battle to be had, and what I see the central banks hinting at is obviously they want to implement their own digital currency. And if we learned anything about central banks in the 12 years, is they are very powerful and they don't like competition. And that's why I think it's actually smart for Bitcoin adherents to say, well, it's not a currency, because if it's viewed as a currency, then that gives ever more excuse to central banks and national governments to say, no, we control currency, you do not. Okay. If you then want to view it as a store of value, fine. A bottle of wine can be a store of value, right? You can. I see bottles of wine being bid up by the hundreds of thousands of dollars. You don't use it as a bottle of wine to drink it. You use it as a store of value. Fair enough. So that's still I think a journey that needs to be undertaken by Bitcoin. And I think, if it wins ultimately, fair to everyone, and I wish everybody good luck. I have no ill will to anyone trading Bitcoin or holding Bitcoin or what have you. I'm just saying I suspect there will be a battle, and that will come from the Treasury and central banks, and we cannot yet know how that will turn out. And to my earlier point, there may be better alternatives emerging. There may be more efficient or cheaper ways of doing it. And it doesn't matter what you and I or Bitcoin adherents may think about how wrong a Janet Yellen may be. they're the ones with the power, and they will, when they do their thing, whatever the thing will be, is they will use whatever excuse that is in their minds to justify the action. And so that is something I think everybody just should be aware of. I would be, let's say, very surprised if there was not an effort, at least, to heavily regulate it at some point in the future. How successful that would be, that's a completely different debate to be had at that point.
Since you mentioned other alternatives, where do you see value in markets or any asset class currently, both in technicals and on a fundamental basis?
Well, for me right now, again, we're mostly index traders, right? So we're looking at the large indices, and it's been kind of a rotation game. For example, March 5th, I put out a little video about some of the technicals that had suggested that we're going to see a big rally, and especially also in tech. Also, tech has been lagging right now. So I think we need to very much see the outcome of how this whole yield equation plays out. I think we had some really sizable oversold readings on tech. I'm not touching anything Russell right now. I think it's ridiculously extended. I don't know when it's going to top. Maybe it did top, or it's going to top. I think that index has some major work to do to the downside. If yields drop from here right now, I think NASDAQ could really benefit from that. And frankly, it has to. It has to, because unlike the S&P and the Russell and the Dow, it actually has broken its 2020 uptrend. That is a major red flag. And so far, what it's done today actually is reconnect with its 50-day moving average, and guess what? It rejected. And so there's risk that there's a bear flag building. So my concern is that there is still more downside risk on the NASDAQ if it cannot get above this 50 MA. And then we can have a sizable correction still. I don't know if that's going to happen, but I certainly see the risk that we may have something in the end of the quarter here, in the end of March. And if that occurs, and if we see some key technical reconnects, I think this market is setting up for another buy for a sizable April-May rally. So we continuously look for opportunities, obviously. But in general, again, this market is vastly overvalued. Gold is interesting here. I will point that out. Obviously, it's been beaten to a pulp. I had multiple charts and articles on gold in the last year. That also, along with Bitcoin, had an inverse that played out beautifully. Obviously, we had this massive run up. But now this chart, and I told this, I do these almost weekly market videos where I talk about gold, and I've been talking about the last 2 months, where I said that I think gold is going to frustrate for months on end. It's similar to what it did about 10 years ago. And part of the reason is it's just really overshot technically. It's now suffering from two aspects. One is the technical correction, the rising dollar, and yields as well as having less demand and interest now, because everyone that wants to hedge is going into Bitcoin. And yet it held a key technical levels recently. There's the 50% retrace from the lows and the highs, and it held that. And there is a technical pattern I'm watching that, as long as it holds that level, is suggestive that gold could have a major breakout in the months ahead. But none of that is at this moment confirmed.
Well, thank you for that, Sven. Now we'll be moving to the audience questions, which we have already taken. So the first question is from Khalid Al-Jirawi. He is asking, from 2009 till 2020, we've had the slowest recovery, economically speaking. Yet markets have had a huge bull run because of the central bank's huge liquidity injections. We don't know the consequences of quantitative easing, but if you can just draw a timeline or a prediction of what will crash this so-called party. And what would that mean for Bitcoin, if you have an opinion on it?
Well, let me start with the tail end of the question first. I hear this a lot, that Bitcoin is the ultimate hedge against money printing, and it's a hedge against, markets and volatility. I'm not convinced of that yet, and I'll tell you why. I mean, I posted a weekly chart recently where, just look back to 2020. Did Bitcoin act as a hedge when markets crashed in March of 2020? No, it corrected hard along with it. Since then, Bitcoin's been on a tear and markets have been on a tear. Just look at this year. January, markets made new all-time highs. Bitcoin made new all-time highs. End of January, markets corrected, Bitcoin corrected. February, the same repeat. Bitcoin made new all-time highs, market made new all-time highs. Then we had a correction in the end of February. And guess what? Now in March, markets made new all-time highs and Bitcoin made new all-time highs. So to me, and we're not talking percentage moves. Obviously, Bitcoin is much more volatile. It rallies a lot more aggressively than the market, and obviously it corrects also more aggressively than the market. But what I'm saying in terms of flow, in terms of directional flow, it seems to be going kind of hand in hand, right? And so to say that Bitcoin is a hedge against some crash maybe in the future, I haven't seen the evidence of that yet. So I think that case is still very much outstanding. The other core question, when do central banks, lose control over this construct? Unfortunately, I can't give you an answer. I mean, maybe they never can. I mean, I'm at this point also absolutely flabbergasted how incredibly willing they are to just go balls out and just print nonstop, how they're refusing to even wiggle a little bit on this. I mean, keep in mind, this year we're still going to have $1.4 trillion on the side of the Fed. The ECB just announced they're going to accelerate their bond purchases. They're not stopping. They are not stopping. And you have to wonder, is there this point where there is a natural market, an organic market that says enough? This is getting too distorted. This is getting unstable, and maybe this little move in yields, I call it little because 1.6% on the 10-year is still little, but is that a sign that is certainly at least a challenge to central banks? But they're not going to leave it alone, right? They have to. They're now at this point where they have to manage every single aspect of markets and at the same time have to accept the consequences of this asset bubble. They obviously are very keen on avoiding the question and admitting that they've created an asset bubble, but they have, right? And so the question simply is there a point when all of a sudden, the bond market, for example, just forces central banks to raise rates, and then what's the ultimate impact on markets? I mean, markets at this point cannot handle any raise in rates, and if all of a sudden there is a move that says, okay, well, maybe we're not going to raise rates in 2024, maybe we actually have to raise them in Q1 of 2022, that may just certainly shake things up a little bit, right? All we know is that, as we saw in 2018, when yields rise beyond the point of what this incredible debt construct that has been created over the last 12 years can handle, that you're going to see a market reaction. So far, central banks remain in control, and the efficacy of them to be able to continue to propel asset prices higher still works. I'm just saying, historically speaking, there is no precedence, none whatsoever, that valuation disconnects so far disconnected from the actual organic economy are sustainable. So that's the journey, I think, over the next couple of years, how this plays out, especially when all the stimulus have flown through the system, and we then need to see what the actual organic economy looks like. Because let's be clear, what we're seeing right now has nothing to do with the actual economy. It has to do with this a massive amount of artificial liquidity that's pumped in, checks being sent out to people, and so forth. So we are very much in an uncharted territory here in this regard.
Sven, since you mentioned your last point, the upcoming question from Ali Atmam He's asking about inflation. Do you think inflation is coming as a long-term phenomena or just a short-term spike caused by the Biden stimulus? What are your thoughts?
Well, yeah, I go back to what I said at the very outset, which is demographics. The demographic picture has not changed. We have some of the lowest birth rates in history in the United States right now, and COVID actually exacerbated that from some of the data points that I've seen. So I think you have still that deflationary component in the larger economy, not only in the United States. You have that obviously in other parts of the world as well. So I'm kind of hard pressed to see how you're going to have, other than the inflation that is now caused by supply restrictions and logistical challenges, and obviously this momentary just peak liquidity, throw the kitchen sink at everything. I'm curious to see how you could get sustained inflation with that demographic picture in context, obviously, of technology still having its major deflationary aspects. So maybe on this point, I would conceptually agree with central banks to say it is temporary, possibly. But if it's not, I sure hope these central banks know what they're doing when they keep claiming they have the tools, because I don't think any of us would want to see sustained high inflation like we had in the 70s. It's not a pretty picture, and I don't think it's good for consumers, frankly, at all. And I think that's, this is where, when they say they want to let the economy run hot, well, who's going to get hurt by that first? And I'm afraid it's the very people that got hurt the most during the COVID crisis, which goes back to this whole wealth inequality spread that I'm concerned about.
Our third question is from Abdullah Mufti. Do you think that if the Fed hadn't intervened in the markets, everything would have been better? And do you think the negatives of Fed policy outweighs the positives?
Well, I think, look, in 2009, during the global financial crisis, I think we came within hours of major international banks just collapsing. So I think that was absolutely necessary what they did then, and I think it was absolutely necessary what they did in 2020. I have no quarrels with that. That's their job. That's their prime function. They're supposed to be there in case things fall apart. So I think they serve that purpose, and they should have that purpose. My criticism has been that I think they've overdone it for the last 12 years. I think they've completely failed in their policy targets. Remember, the Fed for years kept printing out these dot plots about where rates are going to be, and every time it failed. They didn't even get close to that. The magic dot plot is basically a fantasy plot. And so my criticism here is that the Fed itself is never held account to the failure of their policies, and I don't think they're really very much honest with the public about their role. And I think that's a discussion that is completely missing, because before COVID, wealth inequality kept expanding, and obviously now this last year was absolutely insane. We had 8 million people that fell below the poverty line. Well, the top billionaires just made an absolute killing in terms of their wealth, and this is a point that's probably not very popular, and it's probably not being spoken about at all, but it's a concern I have. If you look at the political situation in the United States, but also in other countries, we have entered a period, and it's not only because of wealth inequality, and social media and communication goes into that, but I think the frustration that a lot of people have in society, feeling left behind, and we clearly saw this in this recovery from 2009 to 2020. Wage growth has not kept up. Housing prices kept going higher, because obviously when you have all this concentrated wealth, it produces inflation in various pockets of the economy that the Fed frankly doesn't seem to measure appropriately. And so discontentment, you are seeing discontentment. We're having the best technology ever. We're having you can arguably making tons of progress in healthcare and this and that and the other. But as we just saw with this latest election in the United States, people are not happy. People are very frustrated, and frustrated people that are feeling angry and discontented are falling prey to political extremism. We saw that in Europe in the 1920s, obviously, with disastrous consequences. And so I am concerned that this whole wealth inequality spread, how the entire economy, that is how it's structured, how it's dependent on central banks to constantly bail out politicians. Because at the end of the day, let's be clear, central banks don't make policy. They are reacting to what's happening in the economy. It's supposed to be politicians that are supposed to implement policy solutions that are supposed to help the larger economy, infrastructure, education, this, that, and the other. And they all have failed in political polarization, where you are now in the United States where no one agrees on anything. The only thing they agreed on is spending more money. But as you just saw, no one voted for the stimulus package from the other side. And there is no, and look, Brexit in the UK has been a complete disaster as well. And there's been complete polarization. When you get to complex policy solutions that are needed to deal with really difficult structural issues, you do not have the political capability in any of these countries to implement these solutions. Rather, what these politicians have relied upon is central banks bailing them out whenever there's a problem. So these problems keep festering, the issues keep building, wealth inequality keeps expanding as a result of these central bank interventions. And so the only solution so far has been more debt and more intervention. And at the same time, we are still set with this complete division in the population. That concerns me the most, to be perfectly honest, because societies that can't agree on a common reality can't solve complex policy issues. And that's kind of my larger criticism on that.
Okay, so this leads us to our last question. It's from Abdulaziz Attas. He's a big fan, and he would love to hear your opinion about what catalyst can cause this market to correct or crash, in your opinion, or does it even need a catalyst?
That's a very good question. Does it need a catalyst? My answer to that is actually no. It does not need a catalyst. What typically happens is catalysts are attached after the fact. Oh, it happened because of this. No, what typically happens is, and this is where the technician in me comes in, is that we see signals building up. Remember, tops are processes, bottoms are events, and that's exactly what we saw in 2020. There was a process of a top, there was obviously the crash, and then we had an event of a bottom. And the key for us ultimately is to look for a confluence of signals that tell us, okay, this is showing trouble. I give you a simple example. Obviously, we didn't have a major top or anything like this, but from a technical point of view, when we had that run up in February to new highs, after that correction in January, it was amazing to see how similar it had played vis-a-vis January, February of 2020. Why? Because the components of the S&P above their 50-day moving average were a lot lower on the February high vis-a-vis the January high. That was a negative divergence, and we saw the follow through. We didn't see it aggressively in the S&P or in the Dow, but we saw it very aggressively in the Nasdaq, right? So you always want to look for signals, and then of course you get yields as the excuse and so forth. But this is all happening before real yields all of a sudden rise, right? So there's always technical things that are building that suggests that maybe something is afoot. I would add to that, when we get to market extremes like we just are witnessing here with small caps, for example, I gotta fully admit, I never expected small caps to go this high, simply because we've never, ever, ever seen anything like it in terms of these technical disconnects. And so, yeah, you have to wonder, how can that possibly be sustainable? But as I said, tops up processes. I'll just give you an example here, which is interesting in comparison. In 2000, remember you had that big tech bubble. There was that moment when NASDAQ just ripped up to an all-time high, then it corrected, and then it moved to a lower high, right? And that was, interesting enough, the S&P did not correct as much because it wasn't extended as much and so forth. No one at that point could have told you that the tech bubble had burst. No one could have told you the top was in. In fact, this chop in price that then ensued lasted for 6 months into September. S&P almost made a new high, not quite, in September. If you were in that market environment, it would not have been obvious to you at that point that the big downpour is still to occur, and that's exactly what happened then. So we may be at any moment, be it today or a month from now, I don't know, we may see some sort of correction. It may not even look all that dramatic, and we wouldn't know that we may have even topped at that point. So people like to think of tops like February 2020 when you had an immediate 35% crash. No, historically, that's not what happens. Yeah, you get these occasional, like 1987 or something like that, these sudden events. But typically, these things can take time to filter through the system. And frankly, that's kind of where I'm at right now. Because we still have so much liquidity in the system. I think if there ever was a top, it could take a year or two to kind of filter through the system. So you may not have something as dramatic as this historic event of March 2020. You may have something that takes 2 or 3 years to unfold. And then obviously that's going to be an interesting journey for traders to navigate through.
Thank you very much, Sven. You've been very generous with your time and your answers in the past hour. We at the Finance Memo are very honored to have been having you here. We've been following you since beginning of the year on Twitter, always enjoying your posts and everything. So thanks again, and thank you everyone for listening. If you have any last thoughts, we'd love to hear them.
Well, I very much appreciate you guys reaching out. Nice to meet new folks, and that was my first Clubhouse event, so I've enjoyed that very much as well. I think we're all part of, you just have to recognize we're in completely unprecedented times. I think we are witnessing things we've never seen before. I think navigating through all this is a challenge for everyone. And I think we just got to be all stay open-minded and flexible, but obviously be cognizant of the environment that we're in. So may you live in interesting times. I think we certainly are doing that.
Thank you, Sven, and I encourage everyone to follow him on Twitter. His account is Northman Trader. And thanks, folks, and everyone for listening. May God bless you and have a good night. Thanks all.
Thank you.